Hello, you're welcome back once again. Today, Tuesday, the 16th of December, 2020. Yeah, we're back with some good stuff. You know, we ain't gonna get tired making impact. We ain't gonna get tired in helping our clients to be free financially. We ain't gonna get tired, you to keep you experiencing happiness. Money is part of uh, things that cause happiness. So if you are yet to visit our site, I'm gonna get our website boldly written here for you to take advantage of all that we've got. You know, okay. For those who are yet to visit Capital Insight, should not hesitate to do so. To take advantage of the numerous opportunities we have in stock for you, ranging from cryptocurrencies, forex trading, uh, live trade signals. You know, our live trade signals are very superb for those who do not have time, to study forex. You can just subscribe to our live trade signals, where you need no prior knowledge of forex trading. All you need is to know how to open your MetaTrader and place orders. That's all. you know and we made it so simple that you don't need any forex knowledge to trade. Gone are those days where you would need to study the chart, either technical or fundamental analysis to trade the forex. And now, without any single knowledge about forex, with a very limited knowledge about forex, you can be able to trade the forex trading market and make millions. Yeah, become a millionaire just copying trades. So I do hope that you're going to take this opportunity to go through our website in search of any of the you know education you're going to invest on. So you do so. Thank you. Last video covers divergence. And today we are going to be concentrating on more on divergence using the stochastic RSI, stochastic relative strength index. You know, what a very wonderful tool, indicator to use. So we are going to be, adding up to the confluences that will enable you understand and the right time to take your trades and be profitable. Confluences matters a lot if you really want to be on profit always. Nobody want to lose. Though losing is inevitable in forex trading market, but you must lose one or two trades. Sorry, that's what I'm trying to say. You cannot be trading, all your uh, openings, all your trades without a single loss. No, it doesn't work that way. But all that matters is, at the end of the day, your profits engulf or supersedes your loss. You should always be on profits at the end of the day. And that is why observing all your confluences is very important. You need to have a set rules. You have to make sure that 3 or 4 of all your confluences uh, connect before you take any trades. You must be sure that there is an intersection in your confluences, at least 3, a minimum of 3, before you take any trades, for you to remain in the game and constantly profits. Yeah. So today video is going to be brief as well. I've already set up my markup. Only going to be talking about confluence, and you know um, we have we're going to be discussing gap as one of the confluence. Gap. If you don't understand what a gap is, a gap is space between uh, a very strong momentum candle. It exists, you know, when uh, there's a strong momentum candle is created by the previous candle before the momentum candle, and the next subsequent candle after the strong momentum candle has taken place. I don't know if I'm clear. A gap, if I must say, we have 2 types of gap. One of the gap we have is the one created, you know, when the market contract within the weekend, and at the open of the market in the new week, there's always, more often, there's always a gap created in between the candle, a kind of jump, you know. Let me see, I don't think if that usually occur in indices, but the weekend gap is more common in currencies. Yeah, on currencies. So the normal gap that exists in metals and indices is this very type that we're going to be talking about here, the type that exists between a momentum candle, caused by a momentum candle, between a previous candle before the momentum candle and the next preceding candle after the momentum candle. As you can see here, this is the gap between this bullish candle and this bearish candle. There is a gap. If you could check the wick, there is no intersection between this bullish wick and this bearish candle. Let me zoom a bit for you to see. Zoom more. You can see between this candle and this bullish candle before this strong momentum candle and the preceding bearish candle, you can see there is a gap between this and this. This is another example. This gap in between these candles. This is another gap. As you can see, the market respected this gap until it is broken here. But for a very long time, the market has respected this gap. So a gap is always considered as a reversal point. It's always considered as a reversal point. So it is a very, very necessary that we pay close attention to gaps, because they serve as a very, very major, basic confluence when trading. You get it? A gap serve as a very major or basic confluence, stuff like that. So it's a very strong point. Okay, it's like I'm having some interruptions. Okay, sorry. Yeah, we are back. We are back, and we're talking about the gap. Yes. So a gap is a very strong confluence, a very, very strong confluence to watch out for when trading the forex market. It serves as a point of reversal, so it should be an indicator, for you when trading the market. Whenever you observe a gap, what you should be expecting next is a reversal when the price approaches any available gap. As you can see from this very candle, the market has always respected the level of this gap. You can see until this point it breaks through, but for a very long period of time it has respected the gap. As you can see from here, it served as a reversal, even though the trend didn't go far before its breakthrough. But there are instances, occasions where gaps influence the market a whole lot. So you can just observe this very gap here. As you can see, this very gap here. When the market reaches uh, uh, to take a taste of this very gap, it's reverse with some very reasonable amount of pips. Let's check the amount of pips from this gap to here. This is 163 pips. 163 pips. You can see how effective a gap is. So a gap is highly expected to reverse the market when price action has approached that very particular zone. Don't know if you're getting me right. I'm still thinking of the very best words to use to make this as simple as possible. First, you should learn how to uh, how to spot a gap, mark a gap, and then consider it as one of your confluences or as one of your signal. If you are trading the divergence and you discover that the market is about the signal from your stochastic RSI is saying that this market is about to diverge. So you look at if there's a gap close, then the market has a very high tendency of reversing when it approaches the gap. Hope you're getting me. So whenever it approaches a gap, you should expect a reversal. Looking at your stochastics when a signal occur, and let me tell you one thing, you know, some people trade the gap alone with some other indicators, and some observe the price action around a gap to take their trades without more confirmation. But I want us to be at a safer side, and that is why I always advise that we look out for at least 3 confluences before we take a trade, even though price action on a gap has over 50% probability of reversing when it approaches a gap. That shouldn't be a yardstick for us to take a trade. 50% or over 60%, 50% is not enough. So we should look at other confluences to support our claims before taking action. You getting it? Yeah, I know gaps are very, very effective, but nobody wants to lose money. It's better we miss out taking a trade within a gap than to go into a trade that doesn't go our way and we end up losing. It's better to have your bank account at the same level than to go on a negative. So let's not always look into taking a trade to the direction we are expecting, but we should always consider what the market is saying. We should try to listen to the market. So that is it about the gap. I hope you can be able to spot gaps. We have one gap here, we have another here. Let's go through the chart and see if we can discover more gaps. Yeah, it's a very nice gap here. We have a very nice gap here. This is a very nice gap. Then check. Look what happened from this point. Let me zoom closer. See what happened. This is a gap. So when the market comes here, approach back and tested the gap, what happened next? Boom. The market fell. The markets go bearish with, let's count the number of pips from here to here. 157 pips from this gap. You can see we're only looking at gaps here without even checking at other confluences. I told you gaps has over 50% probability of going your way, but I'll always advise us to look at the price action, the reaction of candles within a gap, and other confluences to take on a trade. Okay, look at this gap. What happened? Look at the price action. We have an inverted hammer. on a gap. These are two confluences at a spot. So if you can see the moving average here, moving average can also serve as the third confluences. Price is below the moving average, which is enough for you to take your trade. We have three confluences confirming that this trade is going to go bearish. We have the price action, which gave us an inverted hammer. We have the gap, and we have the price below the 50 EMA. So what next? At least we have three confluences to confirm that. So we go for the market, and if you can see, price not only once respected this gap, twice, three times, the fourth time. You can see you can make a whole lot of money, but I would not always advise that you take your trade on a gap over twice. No, preferably once, but at worst twice. But the first time is always good. It's always good, you know, high probability. Okay, we can use the fibs as another confluence. Yeah, good. As you can see, the fibs here will serve as another confluence to confirm our trade. Look at the inverted hammer. What do you see? It has tested the 50, the equilibrium, the 50% on our fibs, 0.5, which is 50. You can see the hammer has tested the 50, which is 50 is an entry point using the fibs. On a fib, 50 is an entry point. 50, 0.7, 0.78, 0.70, 0.78 are good entry points on fibs. So this is another greater confirmation that we got on our fibs. This is the fourth confirmation now using our fibs. The inverted hammer has tested and has created an inverted hammer on 50. So which is a confirmation that we go for this trade. So you can see this is another strategy on its own. Even without the stochastic RSI, we are able to get up to 4 confluences without the stochastic RSI. So you can see the value we are giving, except you don't want to make money, but if you want to make money, consensus capital insight is the best place to be. We care about helping you make profit, helping you make money, putting the smile on your face now and always. We love to see you happy. So this video, I'd like to call it a day and pause this video. For now, you expect more resources, expect more value from us as we promise. And our launching come January, you will be getting more and more values. You know, the more you remain with us, the more value you're gonna get. Thank you and God bless. Enjoy trading.